Hello, Julien. There's been a lot of press that has highlighted the frothiness in AI-related valuations. And frankly, a lot of articles have compared this market to the dot-com era excesses. How do you see the similarities and differences?
Between the late 1990s and today, there are some obvious similarities, but also some differences, and a few things that are worrying us. Let me explain. The similarities are obvious. The enthusiasm and hype around a transformative technology, the expansive valuation in the public and private market, and the high concentration in equity markets around that theme, and the strong sense of inevitability, AI today, the internet then. The difference, however, are several. One, the technology infrastructure is much more mature. Consumers and enterprises are already adopting AI in their workflow. ChatGPT is one of the most successful consumer product ever, with 700 million weekly active users already. And the listed companies leading the AI race have superior business model. They produce high free cash flow, they have very strong balance sheet, they generate very high returns on invested capital. They are magnificent in many ways. This is changing, however, and it is what worries us. The investment in infrastructure and talents are becoming incredibly large. Amazon, Microsoft, Google, Meta, and Oracle are expected to spend close to $1 trillion in capital investment in the next couple of years. Those businesses are becoming very capital intensive. And while the market is rewarding companies that announce large capital investment into AI with higher share prices, it is not always clear how those investments will be financed, how much debt will be needed, where revenues will come from, what the incremental margins on those revenues will be. What is the duration of those assets? GPU depreciate much faster than fiber. And so ultimately, what will the return on those very large capital investment be? Those important questions that have yet to be answered at a time of elevated expectation and valuations concern us. So in that arms race to reach superintelligence, the risk of capital misallocation, potential value destruction is increasing, and we monitor it closely.
The global value team has historically done a good job at avoiding those areas of the market that have gotten stretched. When it comes to AI today, how are you thinking about that market and how are you gaining exposure to it?
We are bottom-up fundamental investors, not thematic ones. And so in the US, we've owned some of the companies leading in AI for many years. And while we are enjoying the rising tide, we're also very disciplined when it comes to valuation, and we want to make sure we risk manage our position correctly. We also take advantage of our global perspective, and we seek investment across the entire AI value chain. For example, we own a copper mining company in Mexico. Copper is benefiting from increasing demand in power and electrification, and new supply is limited. We own a French company that provides electrical product to AI data centers and benefits from higher capital investment spending. In Taiwan and South Korea, we are shareholders of the two leading companies dominating the global semiconductor foundry market. NVIDIA uses them to produce all its advanced AI chips. So we're taking full advantage of a global flexible mandate, investing along the entire value chain to own what we believe are some of the best assets, the most attractive valuation that are benefiting from the developments in artificial intelligence.
Thank you very much, Julien. Look forward to speaking to you next time.
Thank you, Anirudh.